Welcome to EduFund. In today's episode, we have a very special guest with us, Mr. Sailesh Jain from Tata Mutual Fund. Sailesh is the fund manager at Tata Mutual Fund, managing Balanced Advantage Fund, Multi-Asset Fund, and Nifty Midcap 150 Momentum Fund. Sailesh brings over 2 decades of experience in the Indian capital market. Prior to joining Tata, he has worked with Refco Securities, IDFC Securities, and also Lotus Indian Mutual Fund. Qualification-wise, Sailesh holds an MBA in Finance from Queensland University of Technology from Australia. Let's hear from the expert himself about how he goes about managing the funds. Welcome to the show, Sailesh.
Yeah, hi.
We'll start with the Balanced Advantage Fund.
Right.
As you know, Balanced Advantage is a part of a hybrid fund, hybrid category. How do you go about stock selection as a process, and how do you try to manage the risk in the overall fund?
Right. So let me start with how the Balanced Advantage Fund works. So for us, so let me put it simply. Balanced Advantage funds are dynamic asset allocation funds. What I mean by dynamic asset allocation is basically it moves money dynamically between equities and debt. On the allocation part, we have a two-balance approach. One is basically we look at Model A and Model B. Model A is basically nothing but it works on the PE basis, where basically we look at the forward and the trailing PE, where the average is drawn. And on the Model B, which I said is basically nothing but what it looks into basically the global market volatility and the momentum indicators. So when I combine with this, we have created the allocation, equity allocation and tabular form. So if the reading of the so basically it will tell me that how much equity allocation it needs to be put into. Either it ranges between 40% of the AUM should be into equities, and it goes up to as high as 80% of the allocation should be into equity. So this is where the allocation effect is. On the selection effect, we as a house we follow GAR. That is nothing but growth at reasonable price. We don't look at deep values for investing. Neither we look into stocks which are extremely expensive. So for us, we have to buy. We have to do a blend where stocks are growing and they are reasonable or fairly valued. So that has been our mantra for our investment into the Balanced Advantage Fund. Now, as I said, it is a dynamic asset allocation fund. So let's take a hypothetical example that if the model or the output of the model is saying that you need to invest 40% into equities. For us, we will do that. We will put 40% into the long only equities. 25% will go into the arbitrage because we need to maintain the minimum 65% equity allocation, and the balance will go into debt. Hypothetically, if the market sees some amount of correction and the PE falls for the Nifty, and then the model indicates that you need to put higher allocation to equity. For us, we will cut down the arbitrage, increase the allocation to the long only equity. And if the need basis says that you need to go beyond 70% more into equities, the debt portion also can be cut. So this is how the equity allocation works. Hypothetically, if we were at 70% equity allocation and the market calls for putting money into the debt, the equity portion will be cut and the allocation to debt will be increased. So this is dynamically done based on where the markets are and how the valuation of the market is at.
One common question which we have seen from the investors that 78,000 is very costly, and you mentioned about PE as one of the approach. So how do you try to, put that into your, fundamental of managing the fund? And do you really think that the market said 73,000 is very valuable, very expensive, and how should a retail investors participate in this?
Right. So the headline number may look like a larger number, but if you really see in the long-term average, Nifty on the forward earning is still trading at its long-term average. Even on the trailing basis, it's very near to its long-term average, slight percentage point up and down. So there will always be bouts of or areas where you will always look where there will be opportunities where you will look to make money.
Yeah.
At any point in time, there will be some sectors which will look slightly expensive, and you will always find opportunity in the sector. So what is critical is that how quickly you understand that and where are the growth opportunities. So in theory, it will be more of a bottom-up approach when you see market are slightly more over valued, which obviously personally we don't feel. We feel markets are fairly priced or fairly valued. But even if that is the case, you will always find opportunities, select opportunities either in stocks or sectors.
When you talk about the bottom-up stock selection approach in the entire equity portion of the fund, what kind of market cap-based allocation have you seen, and what is the trend which you are going to follow over the next couple of years?
Now, because we manage a lot of diversified funds in our portfolio, for us we are actually we really don't follow a significant large cap-based investment, but for all investment purpose, we definitely have an X percentage of market cap which we look into it, and we do look to investment above those, and that is only for the purpose that just to ensure that there is always liquidity if we want to exit and enter the particular sector or this stock as we refer to. So that is what we look into it. So though as I said that we don't have a specific allocation to an X market cap, we keep on looking at opportunities which are available in the market, may it be into large cap or a mid cap, and we look to invest in those.
Let's talk about the multi-asset fund a little bit. Multi-asset is a very diversified kind of a fund with different asset classes, right? It also probably invests in commodity or the gold market. So if you can throw some light on the process of selecting the names in the multi-asset fund and how do you balance the risk?
So again, multi-asset is actually a very good category which SEBI has introduced some time back. What it does is basically it has investment into three categories, which will be one, obviously, as I said, equities, where you need a minimum investments of 65%. That could be a combination of long-only equities plus arbitrage. The next part is the debt. And what is interesting is basically the commodity part. Now, commodity could include long commodities or basically an arbitrage into commodities. So this fund gives you an exposure to, and again, gold is a part of the commodity. I'm not saying it is the only commodity which we invest into, but it is one of the commodities which we look into invest. Now, there are a lot of opportunities into equities and debt which we have spoken, but commodities also give you a lot of opportunity to invest. So we have been actively doing arbitrage into commodities and also going long on the commodity. Now, in terms of the approach, because this product is widely diversified between equities, debt, and gold, it gives you a natural diversification hedge to your portfolio. So, assuming if you are long equities, because you are forced to invest into some amount of money into debt and gold, it gives you a natural hedge to your equities portfolio. So, if either of the asset class is seeing some amount of selling, the other generally tries to hold or generally tries to add value to your portfolio. The percentage of the commodities and the debt can move here and there, but you need at least minimum 10% is what you need to invest into each of the asset class.
How do you see the investors should play the multi-asset fund if they want to take exposure to diversify the overall portfolio? Should it be more like a lump sum investment? Should it be more like a staggered approach using an SIP route? What is your philosophy for retail investors specifically?
So I would always recommend to retail investors that timing is just not possible for an individual, whether it may be a retailer or an institutional investors. But having said that, retail investors, I would always recommend that look to do SIPs, and that should be a very, very disciplined SIP what you would look to. The reason being very simple, that since you can't time the market, an SIP generally gives you a well balanced investment NAV because it is self balanced through the months. I think that will be the best approach for an retail investors. Now, having said that, if you find opportunities periods like COVID, when market actually corrected very sharply and you were sitting on an excess cash, then I think probably at the point in time you could still look to invest a lump sum. But having said that, where we are now on the index and where the market are now, I think SIPs would be a very, very good approach to start from.
If you see the equity inflows, it has increased significantly in the last couple of years. So how do you manage that when you're trying to manage the Balanced Advantage and multi-asset fund?
We've seen significant inflows on both of these funds on a daily basis. The good part is that markets have been very, very buoyant. Thankfully, markets have helped us. So the whole idea is that because these funds are quite balanced in their approach in terms of the way the asset is allocated among this fund. I think in investments, as I said, that there are a lot of opportunities in the market, and because this fund is not restricted to any of the market cap in terms of its investment approach, my view is that inflows are well managed. There's a lot of opportunities available in the market, and there are a lot of sectors available in the market. So as we have said, there will be a time when an X sector will do better than the Y sector. It is just up to the fund manager whether he finds how the opportunities in each of the sector. Even among the sectors, there will be a lot of opportunities among individual stocks. So my view is that with the way the markets have been behaving, there are a lot of opportunities available in the market. And I think the newer investments which are coming are easily invested in this kind of markets. So I really don't see any challenge as far as the inflows are concerned and managing those inflows.
All right, let's talk about the 150 momentum midcap 150 momentum fund which you manage. It's more like an index fund where the alpha generation capability is probably not there, and you're trying to track the index. So if you can throw some light about that, and where do you see that space, and how do you see the future of that space, considering a lot of activities is happening at the macro level, and the recently announced budget was also there, which is having a lot of focus on infrastructure and other related sectors, talking about growth in the economy. So how do you see this space growing?
So I think as we have seen, mid caps and small caps have seen a lot of euphoria in last 1 year, 2 year. If you really see, they have actually outperformed large cap by a very, very large number. Now, in last 12 months, they would have outperformed anywhere by close to what 30-40% the mid cap and the small caps now. Over the period of 10 years, also they have outperformed large cap by a bigger margin now. Now, having said that, this is an index fund which we are talking of, which has 50 stocks into portfolio, and it is actually based on the momentum. Now, what I mean by momentum, it looks into the price reaction of a stock. The portfolio is balanced every 6 months. The good part is that because it has no emotion involved in it, it replicates an index. The portfolio is off the emotional bias. So whatever stock has performed well will come in the portfolio. Whatever stocks have not performed well will go out of the portfolio. That's the beauty of this portfolio. Because it's an index fund, the cost, the management fee is almost negligible because it doesn't have any human intervention in terms of its processes. And I think the selection of the portfolio, as we have seen, has been phenomenal in last one and a half year when we have been launched. The performance of the portfolio has been very staggering. My sense is that mid cap as a category, if you really see lot of sectors which are into fancy, whether it will be chemicals, railways, or you see any companies where which will benefit from the PLI, will be typically more or less will be from the mid cap segment. So here we have a fund which looks into stocks which have done well, which is dedicatedly from the mid cap categories. And if you look from the investment period, which is basically more than 1 year, anything beyond 3 years, 5 years, then this category or this fund as a whole will look to do very, very well. So my sense is that because it's an index fund, it's a fund which is very disciplined in terms of its stock selection, in terms of the rebalancing. Please have a look at this fund. I think this fund from a longer term perspective will do well. As we have seen historically, mid caps have outperformed the large cap over a longer period, whether it be 12 months or whether it's a 5-year period. I think we are very optimistic of this fund.
Right. So you mentioned about mid caps outperforming large caps, and generally we have seen that people prefer an actively managed mid cap fund or an actively managed small cap fund, whereas this fund is more like an index fund which is tracking the index. Right. So how do you balance that viewpoint of the investors? What would be your recommendation to investors considering exposure to mid cap?
So the idea of launching this mid cap fund, which is basically nothing but a replication of an index launched by the NSE, is just to give you another avenue to invest. Now again, we are not competing against the actively managed mid cap funds. The idea is that keeping the cost low, giving an exposure to stocks which gives you which have performed well and which we believe will continue to perform well, is basically the whole objective of this fund.
My next question is around Tata Dividend Yield Fund. So can you throw some light about Tata Dividend Yield Fund, and what kind of stock selection process do you have? How do you see the dividend yield changing in the Indian market, and which kind of investors should actually buy into this kind of a fund?
So what is this fund all about? Now any company which gives you dividend is cash rich, making profits now. So that gives you one line of defense already in this fund now. Now what is dividend yield? So dividend is nothing but the amount of dividend a company pays divided by its price now. Higher the dividend yield is better for the investors now, logically. But that doesn't mean that the stock would underperform. In fact, the other would be true is that as the company keeps on doing well, the dividend output from or the dividend outflow from a company keeps on rising. We have managed it in a very, very balanced approach. We have a healthy mix of value and growth. We also have some of the stocks where we believe are turnaround candidates now. The fund typically there are many names also which were value when we invested are actually become growth names now. A lot of PSU names have given significant large amount of dividends, or they are other high dividend yielding stocks, and they have actually done very well in terms of their performance also. So if I would really say that the dividend yield fund for us is a healthy mix of value and growth. It is not a sector bias, neither it is a market cap bias. There is a healthy mix of market cap, which is basically ranging from the large cap to mid cap, to some small cap as well. And again, it is, as I said, that there is no bias to an individual sector. For us, if you really see, once a company is giving dividend, it ensures that the product is well accepted in the market. The management is doing a decent set of work in terms of generating profit, generating cash flow, and that is distributed to the investors. So in a nutshell, companies giving dividends generally are perceived to be companies which are doing very well in this market, and that's what the fund is all about. The fund performance has been quite good, and my sense is that if an investor which is looking for a steady state of income in terms of generating through his investment from the company, I think dividend yield stands quite a tall fund, and it should be a part of his portfolio now.
Where do you see the dividend yield in India going? I mean, India is an emerging economy, and it's said that as you grow towards becoming a developed economy, the dividend yields are supposed to increase. So have you seen this kind of a trend already, and is the companies preferring more dividends to ensure that the shareholders' value is created?
So you're right. I think dividends from the company in India have also gone up. Now, if you really see during the COVID period, some of the sectors were actually so there was a mandate that some of RBI came out and stopped banks from giving dividends, which has been reversed now. So if you really see from the portfolio perspective, there are some set of sectors which are very, very consistent in giving dividends. So they believe in sharing an X percentage of their profits with the investors. This is a trend which is followed by a lot of companies now. Everybody has their asset allocation policy in place, which says that whatever X percentage of their profits will be shared with the investors, may it be through the dividends or may it be through buyback. So my view is that this is a healthy trend. This gives investors an alert that yes, the company is doing very well. They is generating enough profit. The product is well accepted, and they are ready to share a part of their profits with the investors in forms of dividends and buybacks. So my view is that this trend is on the rise, and I think this will continue the way it is right now.
In terms of risk for this kind of a fund, since these are all cash-rich funds, companies giving dividends, do you see the relative risk in the equity in this fund is going to be on a lower side as compared to the broad market equity funds? And what kind of an investor should look at this kind of a fund?
So you're right, as I said earlier, that these funds invest into companies which are paying dividends now. So when a company is paying dividend, it is perceived that the product is well accepted, it is throwing up profits, and it is throwing up cash profits as well. So as you rightly said, it is not investing into companies which are either startups or which are loss-making companies for the initial period, and that ensure that some amount of safety for an individual. So my view is that, as I said, these are products well accepted, and in the process where those companies are not trying and testing newer products, but those companies, when they mature, will obviously be part of their investment for these funds. So as I said, as you rightly pointed out, this is definitely lesser riskier than the direct equities if you really compare it to them, but again they will be slightly more riskier than the hybrid type of categories. So anyone who is looking for having an equity exposure or equity returns higher than the hybrid funds and looking lesser exposure, lesser riskier than the directional equity only fund, then probably dividend equity funds should be a part of the portfolio.
That's all from our side, Sailesh. Thanks a lot for your time and sharing your valuable insights.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.